Doom, doom. All right, guys. Gold. Some more cool ideas from Diggin Norway. What about checking the miners? So gold stocks. I'm going to check the ETF as the ETF that's going to cover gold miners. How do they do versus gold itself? And I'm going to stick with gold and USD. And when is it best to be long gold miners versus when is it best to be just holding gold in US dollars? And that's very, very interesting relationship that I got a little bit of data. I don't got before 2007. So this pretty much the chart for the gold miners. 2008 when there was a drawdown, when we had that market crash, they really went down hard, and we'll see it when I compare it to the gold xauusd or the gold futures, gold expressed in US dollars, that it didn't drop as much back then. Nice write up. Usually the write up is hotter, better for the miners, maybe because it's part of the stock market. There are companies, they deal in gold, so they're impacted by the price of gold. But there's more maybe speculation related to gold miners. And after that, they do outperform gold expressed in US dollars at certain moments. But look at the drawdown. Does this look like the xauusd chart? Doesn't really, right? There's a lot of points where it just didn't follow. Look at that. This we had since I think 2011. We had it going down in xauusd, but we didn't go down that far. And right now, this section here, this consolidation, is more up here. So I think the best thing to do right now would be just to go on the weekly. And I'm going to pop open. We're not going to compare it to the SPX. We're going to compare it to gold futures. There you go. Ooh, bingo. And I'm also going to pop open correlation. So I always like looking at the correlation. Sometimes, it's supposed to follow. Well, if you really compare it with the correlation, you get to really see when it did. So a 1, if you get 1, that's a perfect correlation, positive correlation. So if 1 moves up 1. If we would get a minus zone, that means it's, at 0, it means there's no correlation or close, none to. And if we had negative territory, let me zoom back out. And if we get -1, that means it would be inverse. That means gold miners move in one direction. That means gold futures and US dollars moving the other one. And it doesn't happen. Up to 2007, never happened. The worst correlation we got was minus 0.25. So it's still far off from 1. And look at that. So most of the time, so it's not perfect correlation, guys. Most of the time, it's close to 1. If I'd have an average, I could have an average. Can I? How can I add? Maybe I can't. But it's not perfect. So I'd say maybe right about here, an average probably 80%. So there are some differences. Here's the cool thing. That's Weinstein-Mansfield indicator. When it's red, you're below declining 30-week moving average, and you're underperforming the instrument right here. So now we're underperforming gold expressed in US dollars. Anytime you're below 0, right here, you're underperforming. So that means gold's doing better than you. If you're above the 0 line, you're doing better than gold. Here you're barely doing better than gold. All that for years you were underperforming gold. Gold miners not doing so great versus gold expressed in US dollars. A little bit above, underperforming. Oh, so when it decided to go up here, the miners really were doing great. A little bit right here, but most of the time underperforming gold, and right here just barely. So I think I have a lot more area underperforming, more coverage. So since 2007, more coverage of gold miners underperforming the gold. So it's kind of hard to say, oh, I'm going to play gold, I want to play miners. Most of the time, you're not outperforming gold, giving you less return on your risk. Look at that long stretch. And this probably hurts. So if you think gold's going to go up during a market crash for whatever reason, you might get triggered out because the stock that you're in, the gold miner stock that you're in, he might draw down and trigger whatever sell stop you had way more than gold did. And you see here how you underperform gold. So gold resisted the gold value. The miners took a big hit. Their companies, they're in the stock market, the whatever mechanisms in there, banks, hedge funds, they have to they're taking their money out of those positions, and it really suffered more. And you see it here, really starting to suffer versus the gold. So even if the correlation is staying high, the delta each time it goes down more and more, it really hurting more those gold miners. On the way back up, sure. So if we're close to a top right now, this is a 2011 top. If the miners seem to be doing a top and the markets seem to be doing a top, 2008 we had a lot of symptoms. We had the monthly defined tops on the SPX, NASDAQ, the Russell. You want to be long gold expressed in US dollars. You don't want to be long gold miners if you had a choice. If you really want to do gold miners or gold futures, you'd be better gold futures at market tops. At market bottoms, right here. So when the market was bottoming out, when unemployment was super high, when you had all economic data telling you that you were at the bottom of a cycle and you were going into a bull phase, then you could get rid of some of your gold futures and then go into gold miners so that you could profit from that stock market going up, all that liquidity going in the stock market and not necessarily in gold futures. And then you could outperform gold in those phases here. So right now, 2018, same type of thing. If you believe that you're at a market top, then gold miners are probably going to drop more. Maybe all the way down here. They're probably going to drop more than will gold. If the gold is part of that dynamic that it needs to go down during the next bear market or the next crash. So here you would start seeing gold miners underperforming gold, as gold, instead of going down this much, I'm going to add it right here. Let's pop up the gold chart. Ooh, lots of lines. So gold, instead of going down that low, maybe it's not going to make lower lows and it's going to bounce back up and you have less chances of getting triggered out. And here you're going to start going in the red, underperforming gold futures, gold expressed in US dollars. And that's where you don't want to be long gold miners. You're part of these power zones where you'd bear off with the gold futures than the gold miners. Uptrends, even here, 2016, 15, that's when the stock market started getting out of that rut of that 2015-16, stage 3 on the monthly chart, almost stage 4 on the SPX, on those big indexes. And here, gold miners, when the stock market exploded, they were outperforming gold futures. So you want to be long gold futures at market tops. You want to be long gold miners at market bottoms when you're turning around. That seems to repeat over and over. I think I have to deep dive this a little bit more, but these are my initial observations on when you should be long gold miners, when you should be long gold futures. with some moments where there's no correlation. If you'd have perfect correlation, you'd pretty much it'd be a coin toss which one you want. But since they aren't, then it's better to know what you're dealing with when you want to minimize your risk and increase your reward. Choose the correct instrument in the where you are in the context of the cycle, the business cycle, the stock market cycle, where you're at. And the Mansfield has a lot of value. Stan used it as to know when you're breaking out versus your index, you're outperforming it. But you see, it has many other uses, and you could deep dive it and understand, compare two different components, and see when it's time to enter one and when you're better off with the other one, guys. All right, so that's it for gold. I'm gonna keep deep diving that and learning more and more about it. Hope you enjoy it. Thanks, guys. Ciao.